was thinking that there was an Emmy for best ESOP presentation, these two presenters would win for sure. First, a little bit about WBL, CPAs and advisors. We are a full service accounting firm, audit, assurance, tax planning and compliance, business consulting and accounting, and expertise in transaction services, high net worth families, staffing companies, and much more. We've been doing it for about 41 years, both domestically and internationally. We're an independent member of Russell Bedford International out of the UK. So we have affiliates all over the world. We're proud to have been named this year the best firm to work for by Accounting Today, that publication, #1 in the country. If you're giving us a standing ovation right now, I can't see you, but thank you for that. We're also proud to work with experts in a variety of areas, and Tenor ESOP Partners is the best of the best with respect to designing and executing ESOPs for shareholder succession. Headed by Andre Schnabl, who we have known well since the days he was a managing partner of the Atlanta office of the international firm Grant Thornton. I'll let him tell you a bit more about his boutique ESOP firm. I'm going to switch here. But first, for those who want continuing education credit for attending the webinar, we'll have periodic polls to evidence your attendance, including this first one. How many employees are in your company? Give it a second here. Excellent. Excellent. I'm going to end the poll here. Thank you for responding. And good. Now I'm going to turn it over to Andre, who will give us the agenda and start talking about really what an ESOP is all about. Andre?
Steve, thank you very much, and congratulations on being ranked #1 best accounting firm to work for. That's quite an accomplishment. Well, good afternoon, everybody, and thanks for having me. Here we have on the screen the agenda for this morning. I won't read it, but there it is for you to absorb. If you could move on to the next slide, Steve. Well, first of all, let me just very quickly give you a brief background on myself. As Steve pointed out, I have an accounting background, and others within my firm have either legal, ERISA, or M&A in their technical backgrounds. We focus exclusively on helping boards of directors, shareholders, and founders, families with their succession plan and selling of their businesses, exclusively using the ESOP platform as the vehicle. And as we will learn a little bit as we progress, that is an option that isn't typically considered. The typical list of approaches to succession planning are listed on this slide. When you think, as inevitably everybody does at some point, about how do I monetize the value that I've created over many, many years in building the business, how do I monetize it? How do I finance my retirement? How do I exit? How do I establish a succession plan that ensures that the business continues? The first option typically is to consider a strategic buyer. Strategic buyers come in various shapes and sizes. They could be a competitor in another geography. They could be a supplier. They could be a customer. There are a variety of strategic buyers that are open as potential buyers for your business. A second grouping would be financial buyers. Financial buyers being people who see your business and see it as a good investment, and also a way potentially to buy themselves a job, and buy a company, run the company, but predominantly, essentially, they are not strategic, they are financial buyers. Private equity being the classic example. Certainly, a management buyout is a possibility, whereby you sell your stock and your ownership to management, and then ultimately they pay for the business over time. They may get a financial partner to help them, and then you retire through that vehicle. Or if it's a family business, potentially transitioning to the family. And then, of course, there is what is today's topic, the sale to an ESOP. And the sale to an ESOP is not brought up as often as it should, quite frankly. And I don't know if this is necessarily a lack of understanding, but there are about 10,000 ESOPs in the United States. So this is not exactly a novel idea, but very often advisors don't bring up the ESOP option. And so hopefully you'll find today, of interest. What is an ESOP? I think most of us are familiar with what a 401k plan is. An ESOP is a retirement benefit plan, as is a 401k, but there is an important difference. With a 401k, typically, the employee accounts are invested in a broad range of public company stocks. And in addition to that, the employees typically are coming out of pocket. In other words, they are making a contribution to the 401k annually. It's a tax-deductible contribution. And their employer makes generally a modest match to enhance the value of the 401k. With an ESOP, the employee accounts invest almost exclusively in the shares of their employer, which obviously is a very different approach. And in addition to that, very seldom is the employee expected in any way to finance this benefit. So they become shareholders without, in fact, making a contribution themselves at all. So why should you consider an ESOP? And I'm going to go through these particular elements, comparing them to the traditional exits of a financial or strategic buyer, or in fact, passing it on to management or to other members of the family. Number one, sale to an ESOP is very, very customizable. When you're negotiating sale of your business to a third party, typically the third party, the buyer, drives the structure of the transaction. Generally, they want control of the business. Typically, they want 100% of the equity of the business. In an ESOP, it is totally customizable to meet the strategic and financial objectives of the shareholders. For example, you could sell 100% of your business to an ESOP, or you could choose to sell 1% of your business each year for 100 years to an ESOP. Totally customizable, dependent on the needs of the shareholders. Second, you get full and fair market value for your shares. One might have the misconception that because you are being so benevolent to your employees and providing such a terrific benefit for your employees, that somehow that means that you're leaving money on the table. Nothing could be further from the truth. You will get the fair market value for your shares. A third benefit is that the shareholders, typically when they sell to a third party, will pay capital gains on the gain on that transaction. In an ESOP, and you will learn this You will hear far more about this from Steve and Petra later on. But here is a unique opportunity to sell your business and to defer capital gains, and under circumstances where you take a few additional steps, that deferral is a lifetime deferral. And in fact, you never pay that capital gains. In these transactions, very often one can negotiate with the trustee, selling 100% of your business, but also being eligible for an option position in your business so that you continue to have an equity interest in the business, although you've already sold 100% of your shares. And here's a really important one. When you sell your business to a third party, you lose control. In fact, if you sell, typically when you sell 51% of your business to a third party, you have lost control of your company. In the sale of an ESOP, one contractually retains control. You negotiate with your trustee, who represents the buyer. The control of the company remains in your hands for as long as you choose, and you only relinquish control when you feel like it, and you relinquish control to those that you wish to have control, which might be, for example, your senior leadership team. Obviously, if you have control, it means that you make the strategic and operating decisions rather than a third party, which means that your legacy and your choice of your successors is a decision for you to make rather than a stranger. This is a continuation. When you sell your business to a third party, very often a lot of people get to hear about it. There are attorneys for the buyer, there are attorneys for the seller, there are banks involved, and the possibility of the news getting leaked out is pretty high. In this particular case, you really have a closed loop, because rather than selling to a third party, you're selling to a trust that you have created. This trust is, in fact, a tax-exempt trust. So you can imagine that if now the company is 100% owned by a tax-exempt trust, and for example, it is an S Corp, you have effectively eliminated income taxes on that S Corp, because there is no reason to make a distribution of profits to a tax-exempt entity to pay taxes, because they simply don't have to pay taxes. So you've created a profitable tax-exempt entity, which, needless to say, has enormous competitive power in the marketplace. And finally, as I mentioned a little earlier, you protect your company's legacy because you maintain the culture that you have built even after the transaction. I wonder if you'll bear with me while I get into a little bit of the technical stuff. Having discussed the advantages of an ESOP, let's just talk a little bit about how do we accomplish this. What we've got in this slide is we have the company in the center. We have a component representing the shareholders, the ESOP trust that I referenced, a bank, which is very often a part of the transaction, and the employees. So the first thing that happens is, number one, you create an ESOP trust, and then the ESOP trust buys the shares from the current shareholders. And Steve, if you can advance the slide. So effectively, the ESOP buys the shares from the shareholders, and because the ESOP trust doesn't have any money, at this stage in the transaction, the shareholders simply accept a note for the sale of those shares. The second stage is that the company assumes the liability of the trust's note to the shareholders, so that now the company itself owes the shareholders the purchase price for the business. And a part of that note is typically paid upfront by the company approaching a financial institution and borrowing based on the company's profitability and on the company's balance sheet. And those proceeds go immediately to the shareholders. So typically, that would represent between 30 to 40% of the total purchase price of the shareholders gets paid to them in cash through this financing mechanism upfront. The company and its profitability annually, and remember that under many circumstances, now the company is no longer paying taxes, so its ability to pay off a bank is far quicker than a tax-paying entity, pays off the bank, and then at some point in the future, usually year 2 or year 3, goes back to the bank for additional proceeds to pay down the shareholder notes yet again. And typically, the shareholders that did the original sale are fully paid off somewhere between year 5 and year 7. Now let's talk about the employees. Each year, the company makes an ESOP contribution to the ESOP, and the ESOP turns around and pays that cash back to the company and pays off a part of the inside loan that it owed the company when the company assumed the liability to the original shareholders. When the company makes that contribution, shares are released from the trust to employee accounts. So each year, shares are released into employee accounts, and at that particular point, each year, the company is valued so that employees know each year what the value of their account is in the company itself. And then on retirement, the employees sell their shares back to the trust and cash out and monetize their retirement benefit. Or if in fact they are not of retirement age and are just moving on to another employer, regardless, they will sell the shares in this particular business. They can roll it over into their new 401k with their new employer, or they could choose to effectively cash out and use the benefit right then and there. Steve, I think I've covered a lot of material, and a lot of the slides that follow are really largely repetitive of what I have said. And seeing I've been talking for 20 minutes, I think this is good information for the participants on this call to read these slides, but I think I'll pass it back to you at this point.
Okay, thanks, Andre. So we'll flip through quickly just some of these other slides, the benefits of ESOPs to shareholders. Again, as Andre said, customization of the transaction to fit objectives for each shareholder, selling shareholders receive the fair market value, they receive the tax benefits, they receive significant cash at closing, and again, they can have the equity rollover. Let's see.
Steve, I wonder if I could just make one comment regarding the equity rollover. In this market, in the transactions that we have negotiated with trustees in the last 24 months, the equity rollover for selling shareholders is somewhere between 20 and 30%. So I just wanted to make that point because effectively the selling shareholders have sold 100% of their company, but at some point, 5 to 7 years down the road, they have the ability to sell again another 20 to 30% of their business. So it really is a second bite of the apple.
Excellent. And that's what some of these other discussions are about. I'll skip through this just to save a little time. Okay. And then the benefits of the ESOP to the employees. Employees become shareholders. So without contributing their own cash, they become owners. The hope is that productivity improves. Everybody's motivated. And everyone's motivated to help with the succession of for the success of the business. Okay, we got another poll for those who need continuing education credits. This question, what industry are you in? Okay, we'll wrap up this poll. Thank you for participating. We will move on to Miss Petra.
Thank you, Steve. I'm Petra Orquiola. I lead the firm's assurance practice. So I deal with audits and reviews of ESOP companies as well. So what I do want to highlight in my piece of the presentation that the financial reporting for ESOPs is not that complicated. There are some nuances that we need to be aware of, and we of course can help with, but it is not a scary transaction that nobody knows how to account for. For the leveraged ESOPs, when a company goes and borrows debt from a financial institution, as Andrew was educating us on, a lot of the funds are being passed to the former owner. That's the liquidation event that they were looking for. So there is a redemption of their interest, and the company, in most of these cases, assumes some debt directly from a bank institution. On the next option, externally leveraged, the ESOP borrows the funds directly. The company doesn't. It is the ESOP itself, the trust, that goes and borrows the funds. But it is very rare. It's typically the company, because the company has assets that can serve as collateral to the financial institution. So how do we record the initial ESOP transaction? It is not difficult, as I said before. There is debt that is being assumed by the company, so that is being recorded. There are some other equity instruments, as Andrew was saying. That's the possible second bite at the apple, when maybe warrants are issued at the same time, and the former owners have the options to have still 20 or 30%, as Andrew was saying, of the company, and they can regain some of that ownership that they had before at their choice. Now the cash is that is being financed by this transaction is being advanced to the owners, of course, for as a payout for their contribution over the years. But there's also a debt that is being passed on to the ESOP itself. And the ESOP buys the shares of the company, so they are the owner, but the shares of the company serve as a collateral to the company until the debt by the ESOP is repaid. Andrew already talked about that transaction. Annually, there's contribution by the company to the ESOP, which effectively releases part of the shares on an annual basis. Typically, the repayment schedule between the ESOP and the company is anywhere between 10 10 to 20 years. So on that schedule, the shares of the company are being released because the debt is being repaid. The debt by the ESOP to the company is recorded as unearned ESOP compensation. It is kind of a weird contra equity account. You're not going to see it anywhere else other than on an ESOP transaction. But it is something that is recorded and it is unique to an ESOP transaction, and it is part of equity, debit balance in equity. So over here also on the right side of the slide, you see we have an accounting manual that we have put together for your accounting department, anybody who is interested in a little bit more detail, how the transaction is supposed to be recorded. There are some examples with math that somebody can follow. And the link is here. You can actually go onto our website and download it. It's about 20 pages. It is not overly complex either, but it goes into a lot more detail than I'm going to here. Thank you, Steve. Advance. So the issues that we should consider, maybe an accountant would ask, the business combination guidance under ASC 805 doesn't typically apply in these transactions because, as Andre was saying, control doesn't typically change. The same management team, the owners are still involved in the day-to-day management until they choose their own successor. So the business combination rules and disclosures are just not required. Sometimes the control does change in these transactions, but it's rare. And if it did happen, the company has the option to value all their assets and liabilities at fair value and show those as at those values of their financial statements, not at historical cost, which is most, that's what most assets are valued at. So even if another consideration to take into account is that even if ESOP borrows the money directly, and it is a separate entity from the company would have to show the debt on its books because the ESOP has no funds to repay the debt, and it is really the responsibility of the company. So under the accounting rules, even if the ESOP borrows directly from a financial institution, the company would show the debt on their books. And then again, that unique weird account, contra equity account, unearned ESOP compensation for the note receivable from ESOP that the company is showing on their books. Then on annual basis, of course, the transactions are advancing. The initial recording is not as difficult, as I said, but on annual basis, there are entries that need to be recorded as well. For the typical internal leverage transaction, as I said, the shares are held as a security, and the annual contribution by the company to the ESOP releases a portion of the shares. They are valued at fair value. As Andre said, the company will have to obtain an annual valuation of its shares. It will also, the valuation would be needed for any warrants that are being issued as well to the former owners. So based on that annual fair value, there would be a compensation expense recorded. Typically, that is shown separately on the financial statements, on the income statement, so the company can show that it is really related just to the ESOP structuring, and it is not part of their normal operations. And as I was speaking about the warrants, the change in the value of the warrants would have to be recorded as well. That is typically a liability, shown as a liability on the financial statements until the warrants are executed and converted into shares. And the annual accounting is also addressed in our manual. So if you have questions on that, it is part of it. You can download it and see it in a little bit more detail. Over here, we are getting into another polling question. So Steve, if you can bring up the polling question for us. Thank you. So take just a few seconds to answer. And I'm going to pass my time over to Steve, who is going to dive into the tax consequences and advantages of going through an ESOP transaction. Thank you.
Okay, thank you, Petra. We'll close the poll. End it now. I know some of our employees are on the webinar, and I hope they're not considering an exit plan out of WBL because we're the #1 firm in the country. Okay, so for those that are really interested in the tax part of the thing, and thank you, Petra, for the debits and credits, which, whew, I'm glad you're here and my partner in handling all that. Because all I care about is the taxes. So as everyone knows, you know, and Andre mentioned, I mean, if you're a selling shareholder, you're selling stock, you got long-term capital gains if you held it for more than a year, and your tax rate's going to be somewhere between 0 and 20% plus state. A lot of people know that. Most people know that. Usually selling stock is better than selling assets because, of course, if you're selling assets, you may have depreciation recapture, you may have some ordinary income that's typically taxed at a higher income tax rate. So if we had our druthers, we're selling stock. But the nice thing about the ESOP here is that you can actually defer the capital gains on selling that stock utilizing the provisions of Code Section 1042. And that's what we're going to spend a little time on here. So 1042 is indeed a beautiful thing if you qualify. So who qualifies? Sellers. Most U.S. taxpayers, and in our case, mostly individuals, other than C corporations, if they're selling stock, would qualify. The stock itself that you're selling has to be, or should be, for 1042 purposes, a domestic C corporation that is not publicly traded. But there are ways we can strategize. If people on the webinar now are saying, oh gosh, I'm an S Corp, now what? We can strategize for S corporations and partnerships and LLCs treated as partnerships. So don't fret, talk with us, and that gets in a little more detail, but we can certainly work through that. For 1042 to work, the ESOP has to own at least 30% of the corporation immediately after the sale. So you may have some shareholders that will sell and get it to 30%. And later, if other shareholders decide they want to sell out, as long as the ESOP owns 30%, that second tranche could also qualify for the 1042 treatment. So what do you got to do? You got to have qualified replacement property. You got to roll over the proceeds, not just the gains, but the proceeds into qualified property, and you got to do it on a timely basis. So what is qualified replacement property? Generally, it's going to be stocks, it's going to be bonds, it's going to be debentures, notes, floating rate notes. We're going to want the replacement property to be long-term assets, right? Why? Because when you sell the replacement property, you're going to pay tax. So the idea is to defer as long as you can. So you want long-term assets that you're planning on keeping for a long time. And then just so that you know, assets that are property that doesn't qualify for QRP, government securities and notes. You can't invest in entities whose passive income exceeds 25% of gross receipts, can't invest in partnerships or in foreign entities. So the replacement period is 15 months. So you're looking at 3 months before the sale, 12 months after the sale. So if you make a sale, you got 12 months after that period to actually replace the property. And they're really pretty strict rules on disclosures, and just make sure that you make sure your tax advisor follows that, and their tax return for the 1042 election to be proper. Some of the other 1042 issues that we want to watch out for and monitor, there is a 50% penalty that could apply if 25% of the ESOP allocations benefit the selling shareholders or certain family members. Okay, so in other words, you can't have a shareholder who's the only beneficiary of the ESOP. So the shareholder sells and is the only beneficiary. In that case, it just doesn't work. It's really for the benefit of the rank and file employees. If you do sell to the ESOP, IRS has ruled that you can't have a partial rollover election. So you really got to sell all of it to the ESOP relative to 1042. And then if you want to cash out, then you sell the replacement property. No problem with that. The basis in the holding period carries over from the shares that you sold. So if your basis is 0 in the shares that you sold in the closely held company, your basis in the replacement property is also going to be 0. So we'll allocate. Hopefully, you don't have a 0 basis in your stock, but we'll allocate that basis amongst the replacement property that you acquired. And then, of course, again, once the QRP is sold, you're going to recognize gain. So again, you want to seek long-term investments. You don't want bonds that can be callable that all of a sudden you're going to have to pay tax on, because once that's sold, you can't roll it over again. Once you sell the qualified replacement property, you can't do yet another rollover. So Andre mentioned about possibly deferring the gain forever. And that is in connection with the fact that if you hold this property forever and then pass away, the death of the taxpayer does not trigger the gain. And under current estate tax law, when someone passes away, the assets that they have at death get stepped up to the fair market value. So, let's go back to our example where if your stock had a 0 basis and you rolled that over into qualified replacement property, that replacement property has a 0 basis, but the fair market value may be $1 million. When the taxpayer passes away, that replacement property gets stepped up to $1 million. How does that then, what happens after that is the beneficiaries of the estate then can sell at that fair market value and pay no tax because of the stepped up basis. And there's also a possibility of combining the benefits of Section 1202. And I don't want to get into the 1202 discussion because that's another complicated area. But effectively, if you hold shares in a C corporation for 5 years or more, you can qualify potentially for a reduction in or an elimination of capital gain up to a certain amount. Okay, so the tax consequences to the company, contributions to the ESOP to pay acquisition debt or to cash out ESOP participants are tax deductible. Dividend payments from a C corporation to the ESOP are tax deductible. Employer sponsoring the ESOP, although it has to pay a 10% excise tax if the ESOP disposes of shares within 3 years. But hopefully this is a long-term play for the company. But if the company after the sale to the ESOP has an offer it can't refuse within that 3-year period, just beware, you're going to have a 10% excise tax potentially. And then Andre mentioned this because this is really important. If you did have a C corporation that you sold, you make then subsequently an S corp election, you can avoid taxes on the allocated profits to that S corp if you properly convert it after making the sale to the ESOP. The participants or the employees, the assets in the ESOP are allocated to the employee participants, as Andre mentioned. And it's all tax deferred, just like any other retirement plan. The participants can roll over their funds to the IRA and defer tax once they leave the company or take the money out for whatever reason. So again, deferral, just like an IRA, 401k. And then ESOP dividends that are paid to participants are not subject to the net investment income tax. Okay, that's that extra 3.8% tax. We call it the Obama tax because it came out when Obamacare came out. But anyway, they're not subject to that NIT. I did want to talk briefly about S corporations because, again, it's important to emphasize that even if you are, if your company is an S corporation, there are ways around that because, again, you've got to be selling to you got to be selling stock of a C corporation. So we'll work with you on that if you are an S corp or a partnership. There are strategies. Again, once if you were a C corp and you elected S corporation, the ESOP pays no tax on the S corp earnings. So that's a nice thing. We got to watch out for state taxes because it is possible that some states may treat the ESOP a little bit differently. And then there's a new rule that just came out for S corp shareholders. So if you do decide you want to be, you're not going to convert to C corp, but you're going to go ahead and benefit from the sale of the ESOP of your S corp shares. There is a rule starting in 2028. I know that's a ways to go, but the 1042 tax deferral benefits, which historically have not been available to S corp shareholders, in 2028 you will be able to sell up to 10% of the amount realized and defer that as well in a rollover transaction. Don't ask me why 2028. Don't ask me why just 10%. That's just the law. And then also we just have to keep in mind the potential penalties dealing with disqualified persons. Okay, another poll here. We can get that up here. Oops, I just blew it. Let me see if I can go backwards. Okay, here we go. Question number 4 for those CPAs. From what you've learned today, are you likely or less likely to plan an ESOP for your company? And by the way, for those CPAs that are on the webinar, interestingly enough, ESOPs, there are some accounting firms that are owned by ESOPs. And BDO, which is, you may have heard, it's a national firm, just sold, the US BDO just sold to an ESOP. So it's not just for the small businesses, and we're seeing it again in the accounting profession. Okay, so I'll go ahead and close that poll. And stop sharing. We're now at 12:45, which is about as perfect as we can get, so we can leave it open for questions. Sure, should people have questions while they're eating their lunch? Let's see. I see at least one in the Q&A. Okay, so I'm going to read this here. Bank loans will typically need to be personally guaranteed by company owner. Thus the company owner is liable if the company fails after their exit. Is this typical? Any way around that? This is coming from a single owner LLC perspective. Andre, have you seen this in your practice?
Yes, I think I can make a comment on that. Clearly, the amount of liquidity that is provided on this particular exit depends on the borrowing power and the collateral base of the company itself. The whole point of selling your business is to take risk off the table. And so we strenuously, in representing selling shareholders, try and minimize any personal guarantees. I would say even in the current market, the credit markets are obviously tighter than they were 2 years ago. But even in the current market, I'm only seeing personal guarantee demands by lenders in, I would say, maybe 25% of the cases. And in those cases, we work strenuously to put a fence around the guarantee. In other words, the guarantee burns off within 12 months or burns off when principal falls below a certain level. So certainly personal guarantees is something to keep an eye on, but it's something that very often can be negotiated with lenders.
Terrific. I don't know if this next question was an anonymous one just to me about my hair looking so good, or maybe that was Andre's hair looking so good. But I'll pass that on. All right. What types of companies are the best fit for an ESOP? What size? Andre, you want to take that one as well?
Yeah, sure. I would say that the characteristics that I think are important is, number one, the number of employees. So I don't think of size in the ESOP connection as a revenue size as much as I do the number of employees. It becomes pretty cumbersome and inefficient for a business with, let's say, less than 15 employees to become an ESOP, in particular if in the S-Corp environment, because there's certain stockholder concentration rules that tend to make life a little difficult. So I would say that's the first characteristic that we'd be looking for. The second is these transactions are dependent on future cash flows. So troubled businesses or turnarounds are not great candidates. So you're looking for profitable businesses with at least 15 employees, then I think that you're already in the game.
Terrific. And good management, right? As well to support. Right. Okay, are reinvested dividends from QRP, qualified replacement property, taxable to the seller when dividends are issued, or do they get deferred as well until the QRP is sold? So yeah, that decision on the dividends is yours after the transaction. That would be taxable. And so yeah, you'd be reinvesting the taxable dividends.
Steve, can I just add, as a non-tax professional, a comment about the 1042
Sure.
trade? In our discussion this morning, it appeared that if you sell your business for $10 million, that you've got 12 months to invest $10 million in QRP. That is technically accurate. However, you can imagine that from a practical standpoint, such a trade very seldom actually works because, number one, there is no ESOP transaction that actually delivers 100% of liquidity within a 12-month period. So that's number one. And number two, people sell their businesses because they want a lifestyle change. In other words, they're looking for liquidity so that they can go to the beach or they can buy a yacht or do whatever. And I just wanted to point out that the securities industry has, in the last decade or so, provided some really interesting 1042 products that allows you to essentially elect 100% 1042 election without necessarily absorbing all of the liquidity coming out of your ESOP sale.
Terrific. Yeah. Thanks for that clarification. Okay, next question. Do you foresee an increase in ESOPs in 2024? If so, what is driving it? Andre, you want to take that? What are you seeing?
Yeah,
What do you
I would say that the ESOP level of activity is driven in large part by M&A activity in general. In other words, the purchase and sale of companies, the ESOP strategy sort of takes a piece of that pie. So the bigger the M&A pie, the bigger the ESOP pie. I would say that the baby boomers are selling their businesses like crazy. And in the last decade, we've seen a gradual and consistent uptick of the sale of businesses, which I believe we continue to expect, certainly for the next several years, as my generation essentially sell their businesses. So I expect continued activity, and certainly as interest rates, as we all hope, get cut, there will be further upticks as a result of the improved credit market environment.
Great, excellent. Andre, in your experience, how soon should we start talking about an ESOP exit?
When you say how soon, you mean the timeline?
Yes. Like how much time do you need really to make it happen? I mean, if I want to exit, 8 months from now, when should I start? When should I start consulting with you to get the ball rolling?
Yeah, I would say that the timeline is broken up into 3 or 4 components. The first component is for you to finally determine that an ESOP is the best strategy for you. And that is typically done through a feasibility study where you compare alternate exits and ultimately analyze the financial and strategic outcomes of those various exits. At that point, if you decide as a selling shareholder, this is my preferred approach, I would say that one needs probably 120 days to effectively get to the closing table.
Okay, good. Another question. Can a privately held 100% owned by one person S Corp participate in an ESOP? And I mean, yes, that the shareholder can sell stock to the ESOP. The presumption again is that you've got employees, 15 plus, that are going to be the participants in the ESOP and the beneficiaries. So obviously, if you're the only employee, it's not going to work. But if you've got a management team and employees enough to make it make sense, then absolutely. Are there certain areas in the country where people are choosing ESOPs? How popular is it in Georgia? Andre, I know you're all over the country. What,
Yeah, I would say Georgia is certainly as active in the ESOP sort of ecosystem as any other part of the country, as far as I can see. But let me just deliver a caveat. You know, we do about 8 to 10 transactions a year. So it's a very, very small sample. So you take any response I make with a grain of salt. But I don't see the Southeast as lagging at all. I think it's very active. I see a lot of activity in California, for example, where capital gains, when you lay over the state tax, essentially capital gains is about a 35% number, including the 3.8% Affordable Care Act overlay. New York State also huge capital gains on an exit. So the 1042 dollar for dollar is greatest benefit in those states that have the highest state tax rates. And so in part, ESOPs are driven by that fact pattern.
Terrific. Okay. I think that's all the questions I see. Obviously, the door is open. The phone is open for you to call, whether it's WBL, whether it's Tenor partners, Andre. I'll be glad to answer whatever. Thank you so much for participating. I think that's it. I think we're done for the day. Finish your tofu lunch. Have a good rest of
Very
the
much, Steve.
have a good
Enjoy.
rest of the week. Talk to you soon.
Thank you.
Bye-bye.
Take care.